Hey guys, I am Deric. Welcome to my channel. In this video, I'm gonna explain to you the basic concept of stocks. Equity capital is the funds paid into a business by investors in exchange for common or preferred stocks. This represents the core funding of a business. For the companies that issue common or preferred stocks, they receive long-term fund, which is provided by the firm's owner. This is a permanent form of financing, as the money paid by the stockholders will stay in the company's account forever. No repayment is required. So, the company doesn't have to pay back the money given by the stockholders. Liquidate in the event of bankruptcy. Liquidate means to convert assets into cash or cash equivalents by selling them on the open market. Claims on income. When the company makes a profit after fulfilling claims from creditors, which means after paying the creditors, then the balance of profit will be shared by the stockholders. Claims on asset. When the company is under bankruptcy process, the company will have to fulfill claims from creditors, governments, employees, and customers first. Then the balance will go to the stockholders. Therefore, stockholders may have a risk of receiving nothing in the case of bankruptcy, if there is no balance after paying other parties. Dividends are non-tax deductible because they are not a part of the expenses. Common stocks are also called ordinary shares. The following are the basic characteristics of common stocks. First, ownership and control of a company. Common stock is a certificate that indicates ownership in a corporation. When you buy a share, you attain ownership rights in proportion to your share of the company. That's why common stockholders are the true owners of the firm. Bondholders and preferred stockholders can be viewed as creditors. As a legal owner of the company, common stockholders are entitled to company's profit by way of dividend entitlements, reserves of the company by way of bonus issues, increase his investment in the company through acquiring more shares. Second, voting rights. Common stockholders are given the right to vote at the general meetings of the company. But majority of the shareholders generally vote by proxy. Proxy means signing over to delegate the voting rights to someone else. Basically, common stockholders are entitled to elect or dismiss the board of directors, approve any change in the corporate charter, for examples, M&A, merger and acquisition, and restructuring. Third, limited liabilities. The liability of shareholders is limited to the amount of their investment, so common stockholders are exposed to limited loss and risk. The limited liability feature is one of the biggest advantages of investing in public listed companies. While you as a shareholder can participate wholly in the growth of a company, your liability is limited to the amount of money you have invested in the company. So your personal assets are protected from being used to pay off any debts the company may have. Even if the company subsequently goes bankrupt and has remaining debt obligations, shareholders are not required to pay for the debts. Fourth, higher potential returns. Common stockholders expect to receive adequate current income and capital gains. Dividends are the current income, while the positive difference between the selling and buying price is the capital gain. Common stockholders are also known as residual claimants who receive what is left, that is the residual income, after bondholders and preferred stockholders' claims on the firm's income and assets have been satisfied. Residual income can be paid in the form of dividends or kept as retained earnings, which will be reinvested in the business. Claim on residual income implies there is no upper limit on income, which means shareholders have unlimited potential for making money from the company. However, on the downside of residual income, it also means that shareholders are not guaranteed anything. They may have to settle for zero income in some years. Fifth, claims on asset. In the event of liquidation, common stockholders have the right to claim on assets after the taxes, employees, debt holders, and creditors have been satisfied. Generally, if bankruptcy occurs, claims of the common stockholders are typically not satisfied. Simply speaking, company does not have money to pay the common stockholders. Sixth, Preemptive Right. Common stockholders are given a special right to purchase any additional shares sold by the company. There are few different measures for the values of common stock. Par value is the stated value or face value of a stock. It is not very useful to investors, mainly just an accounting term. Par value of bonds is important, because that would be the money that bondholders will receive in the future. But the par value of common stocks is different. It is not the money that shareholders will receive in the future. It is only a record in the balance sheet. Book value is the amount of stockholders' equity. This is the difference between the company's total assets, minus the company's total liabilities and preferred stock. Market value is the current price of the stock in the stock market. We also call this as the trading price of the stock. Investors are buying and selling shares based on the market value. Market capitalization is the total market value of the company in the stock market, which is equal to the total number of shares outstanding multiplied by the market value per share. Investment value is the real value, or the real worth of the common stock, also known as intrinsic value. This is the amount that investors believe the stock should be trading for, or what they think it's worth. Probably the most important measure for a stockholder. There are 4 different categories of shares in the company's account. Authorized shares, the number of shares which is allowed to be sold by corporate charter. For example, if the number of authorized shares is 1 million units, the company is not allowed to sell more than 1 million shares. Outstanding shares, the number of shares held to public. For example, there are only 300,000 units of shares currently trading in the market. Treasury shares, the company's repurchase of the outstanding shares for compensation plan. For example, the company buys back its own shares 200,000 units. Issued shares, the total of outstanding plus treasury shares. 300,000 plus 200,000, so there are 500,000 units of issued shares. Next, we will talk about dividends. Dividends are important for many shareholders, which represents the current income of the common stock investments. However, payment of dividends is at the sole discretion of the BODs. Dividends may be made in cash, additional shares of stock, and even merchandise. Usually, they are paid quarterly. Common stockholders will receive dividend payments only after all claims have been settled with the government, creditors, and preferred stockholders. That's what we call residual claimants. Dividend is not a liability of the firm until it is declared by the BODs. Therefore, a firm without any debt cannot go bankrupt for not declaring dividends. Dividends are non-tax deductible for the firm, as they are not a part of the expenses. They are taxed similarly as an ordinary income for individuals. There are 4 key dates for dividends: declaration date, date of record, ex-dividend date, and payment date. Common stockholders are required to observe these dates for dividend entitlements. Declaration date. That is the date when BOD declares the dividend to be given out to the shareholders. Date of record. This is the date on which the investors must be a registered shareholder to be entitled to a dividend. These investors are known as holders of record. Payment date. This is the actual date that the shareholders will receive dividend payment. Usually it is banked into the investor's savings account. Another special date, which is 3 days before the date of record, we call this as the ex-dividend date. Ex-dividend date will dictate whether you are an official shareholder, and therefore eligible to receive the declared dividend. If you sell the stock on, or after the ex-dividend date, that is from June 16th to 18th, you will receive the dividend, as you are the holder of record, even though the stock is sold to another investor. In other words, you are selling the stocks without dividend. If you sell the stock before the ex-dividend date, for example, on June 15th, then the new shareholder will receive the dividend. Simply speaking, if you are a buyer and you want to receive the dividend, you must buy the shares before ex-dividend date. Preferred stocks are also called preference shares. The following are the basic characteristics of preferred stocks. Preferred stock is often referred to as a hybrid security because it has many characteristics of both common stock and bond. Preferred stock is like a common stock because preferred stock has no fixed maturity date. Technically, it is a part of equity capital. Failure to pay dividends does not lead to bankruptcy. Preferred dividends are not a tax-deductible expense. Preferred stock is like a bond because preferred stock pays fixed periodic payments of dividends, either as a fixed dollar amount or as a percentage of the par value. Preferred stockholders have no voting right. Preferred stock usually pays a fixed dividend and has a prior claim on the firm's earnings and assets in case of liquidation over common stock. Priority of preferred stock is lower than debt, but higher than common stock. So in case of liquidation, company will pay debt holders first, then to preferred stockholders. The last party to be paid is the common stockholders. The dividend is expressed as either a dollar amount or as a percentage of its par value. Therefore, unlike common stock, a preferred stock's par value may have real significance. For example, if Apple issued $75 million of 8.25% preference share at $50 per share, taking 8.25% times $50, then the fixed annual preferred dividend per share is $4.125. If a firm fails to pay a preferred stock dividend, the dividend is said to be in arrears. Then the company is prohibited to pay common stock dividend. Alright, that's all for this video. Thanks for watching. See you in the next one. Bye.